Okay, Bismillahirrahmanirrahim. The topic of my presentation is Global Financial Crisis, Lessons for Islamic Finance. I think we have heard quite a lot about lessons from Islamic finance. I'll be talking about lessons for Islamic finance, and actually this should be lessons for the practice of Islamic finance, probably is the more appropriate title. I was informed that I have 20 minutes and I have 20 slides to go over, so I'll try to be fast. But I think a lot of what I will say probably is already covered in the last 2 days of workshop, and a lot of you are aware of what has happened recently. So what I'll do in my presentation is very quickly go over the background and build-up of the current financial crisis. Then I look at it from the risk perspective, and basically try to show that it was a failure of risk assessment and risk management practices by different players in the market. And then ask the question whether the same can happen in Islamic finance practice, and then come up with some lessons for Islamic finance. If you look at the environment under which the current crisis, actually this was not the first crisis in the last decade, 10 years, this was the second crisis, the second burst of bubble. The first was the stock market crisis, but because it was in the financial sector, in the stock market specifically, it did not affect the real economy that much. But the second crisis which we saw was in the real sector, and that's what creating all these problems. So this two bubbles in 10 years resulted mainly because of the regulatory environment under which the financial sector has been operating. And I have listed here some of the things. The Federal Reserve under Alan Greenspan believed that markets can regulate themselves, and they took a hands-off kind of approach to regulation. They let the markets, the players in the market, to do what they wanted to do, assuming that they will regulate themselves. Then there's a Basel II factor to it. Basel II, under its new principles, also places a lot of emphasis on market-based risk assessments of financial institutions. This is one factor, and the current crisis has shown that sometimes when economies go through ups and downs, the assessment can be wrong, especially when the economy is going up and there's a boom, there's underpricing of risk, which means that you underprice the risk and you hold less capital. And capital is the insurance for banks to actually secure themselves when there's a crisis. And then there was a repeal of Glass-Steagall Act in 1999, where they in Glass-Steagall Act, the investment banking and commercial banking were separated. By this Graham, Leach and Bilali Act, they actually allowed commercial banking and investment banking under the same roof. And then there was, in 2004, the Securities Exchange Commission, they loosened capital requirements for the largest investment banks. And these are Merrill Lynch, Lehman Brothers, Goldman Sachs, Morgan Stanley, and Bear Stearns. And all of you know that these are the major players in this crisis. And because of this loosening of capital requirements, in Bear Stearns, the debt-equity ratio increased to 32 to 1. And there has been always resistance to control the over-the-counter derivatives market. Actually, there was a long debate between Federal Reserve and Treasury Secretary Rubin and Chicago Commodities Exchange Chairman. She wanted to regulate the trade, the derivatives which were traded over the counter, and somehow she was not successful. So this is the background under which the crisis unfolded. There were some other factors. There were developments because of the regulatory environment. There were factors which led to innovation of products which were not understood. The other development was the securitization, through which actually the funds were not coming from borrowers and institutions and depositors, but they were sold in the capital market. And this created a dislink between the financier and the user of finance. Now, these are the steps, the initial steps which created to the crisis. Banks and financial institutions engaged in subprime lending, and most of them were with adjustable interest rates. As you're aware, when the subprime lending was going on, the interest rates were very, very low. And due to lax risk management regimes, a lot of banks, they gave out loans to people who did not deserve it. Actually, I read a case where a loan was sanctioned in the name of a dog, and they did not even go and see who the person was. In this case, it was a dog. And then the second step was that these loans were packaged as mortgage-based securities and collateralized debt obligations. And of course, all of you, I think you have seen these processes already, so I'll very quickly go over it. And then these securities were given to rating agencies, packaged in a way so that they could get very good ratings, and then this was sold to the investors. And investors were not only investment banks and hedge and pension funds. The investors were actually a lot of other entities, including municipalities, school pension funds, and they were sold to everybody. And because the interest rates in the market were very low during that time, and these securities were paying relatively higher interest rate, everybody jumped for these securities. And some of these investors, they tried to hedge the risk of default. So they went and bought credit default swaps. So these swaps basically protect the investors, or they get the money back. It's kind of insurance. If there's a default, the seller of this credit default swaps, they pay the holders of these securities the money back. So the issuers of credit default swaps took the risk of default. And if you remember this Freddie Mac and Fannie Mae, they were not really selling credit default swaps, but they were guaranteeing that if there's a default in the securities they were selling, they will pay for it. And that's one of the reasons they went under. So what we see is that in this process there was a new risk profile which was created. With excessive profit motive for driving operations, and there was a deregulation, so this invited a lot of risk taking. And this is shown by the way, by excessive profit motive. I'm talking about here. I mentioned. I mean, what I mean here is excessive greed. So, excessive risk taking was taken in different ways. Of course, one was lax risk management practices, underpricing of risk because they did not understand what the risks were, and the other one was high leverage, or the other word for high leverage is very low capitalization. And the regulatory regime allowed this kind of practices by the financial institutions. And the second part of the risk profile comes from the derivatives market. Derivatives, some of them do transfer risk from one party to another, but they create new risks, and it's very difficult to understand what these kind of risks are. So there were misunderstanding of the risks that were created through these complex securities.